Thanks everybody for joining us today. I will try to be concise, to the point, and hopefully the information I'm sharing with you is useful. I will try to spend not too much time on sort of general comments and jump to the portfolio relatively quickly because that's what we're excited about and that's what's going to deliver results in the future. However, having said that, it's funny you say this, Neil, because it's really 6 years ago where we started. And 6 years ago, we were in a situation which was also quite dominated by uncertainty, and it was dominated by a increasing hostile language between the US and China. And there were plenty of uncertainty about global trade, supply chains, tariffs, currencies, growth, etc. So it seems like quite a bit of a déjà vu. But I guess the still what happened if I go back 6 years and look at my own expectations or our expectations at that time, certainly we did not expect things to become as volatile and uncertain as they in fact have. And of course, some of the largest external factors which drove volatility, uncertainty, and impacted asset prices in emerging markets related to COVID, related to what happened in China, the increasing tension between China and the US, of course, the inflation development, the US dollar, etc., had a huge impact on trade, on consumption, on capex cycles in emerging markets. And the war, of course, and its impact on commodity prices took its toll on many countries. And also more recently and right now, again, it seems like the market isn't allowing us one peaceful night. 2 nights ago, we spent the whole night trying to figure out what's going on in Korea. The only thing that made me feel comfortable is that it was not only us who didn't understand it, also our Korean friends and partners didn't understand what was going on. But I'm happy to talk more about this. I actually, in fact, see this as a great opportunity. It's testament to the strength of the Korean democracy. It was handled in a very good way. I would compare this to the event in the Congress in the US, but of course in Korea, they controlled it much better. And actually, the subsequent expectations right now are quite positive. So it could really act as a re-rating momentum for many Korean stocks, but we can talk about this. What matters most to you and what matters most to us is the performance. We delivered a decent performance over the last 12 months. NAV is up over 16% as of now. And it's sort of based on many different footings. Of course, India has helped. Of course, Taiwan has been a driver, but we also had very positive developments in many other, sometimes smaller markets, such as Turkey. The biggest laggard continues to be Brazil, where we are seeing higher interest rates, where we are seeing, although the economy is actually doing quite well, growing at almost 3% now, still recovering. Exports very strong, imports very strong. There has been a lot of uncertainty around the fiscal discipline of Lula's regime and too much spending certainly there, which is creating pressure on the currency market. But I remain quite optimistic that next year there are very specific developments which will lead to a good re-rating potential for companies in the portfolio. So we have outperformed now significantly since inception. We beat the MSCI Emerging Market Midcap Index by almost 30%, and we have beaten the MSCI, the larger index, by almost 35%. Very good performance over 5, 3, 2, and 1 year overall. And we continue to focus entirely on the long-term performance. And the work we're doing now with the team, I'd love to introduce them to you. I guess many of you know them. The work we do now aims at delivering performance not in the next quarter, not in the next 6 months, but actually over that longer term 5-year period. We're aiming to deliver the same type of performance from here on. So there's a lot happening right now. We've done a lot. We're not standing still. We've taken quite a bit of profits in India earlier this year. We also repositioned our exposure in India. We've also done the same in Taiwan with quite a lot of changes. We added a good handful of positions of small and medium-sized businesses we found. Um, and we continue to adjust carefully. We're not trying to move too much, but we're trying to adjust very carefully so that the portfolio is always reflecting our conviction. I'm not going to bore you with the company and all that. You know this. We're now managing about 400 million, so we've grown quite decently, predominantly in the open-ended vehicle. And the business is healthy. We've expanded the research team more. So we hired another Indian lady to the team who came from a India based local asset manager where she was investment partner for a number of years. And we're very happy that she joined us. So we have 5 now on the investment team, but the team has been very stable. Swathi is in India right now, and we've spent a lot of time traveling in Southeast Asia, which is why I look even older than last time I spoke to you. But it's giving us a great access, giving us very good information, high quality information about companies, and our pipeline of ideas continues to be really, really strong. So just one word emphasizing the difference of the approach. We have a very high active share, close to 100%. The pipeline is made up of stocks which are, none of them are in the benchmark. And we continue to set this bar for ourselves that we aim to look and search and try to identify businesses which are not yet in everybody's portfolio. Mid-cap is still the area where we are most excited about. Simple truth is there are more emerging market mid-cap companies available. They are under-researched, under-owned, not so well understood, and they offer more than ever before a dynamism. They offer an entrepreneurial leadership, and they offer leadership also in intellectual property, evident by patents, evident by skill and know-how that they developed that we have not seen like this before in EM. So that's really exciting. It's not about the retailers, not about the supermarket chains. It's not about the telcos. We're talking about highly focused and specialized laser sharp businesses which are competing globally. And especially in Asia, we're finding those businesses. Now, it's not just a sort of a story. It's also evident by the growth expectations, earnings growth expectations, and the pools of earnings that these companies are diving into, and some of them are actually developing their own markets, like E Ink, one of our top holdings, which is the world's leading business in electronic paper. They've recently come out with a color version, so they're actually creating a market. And with that dominance and almost monopolistic position, and their very fast growth into electronic shelf labels, we expect this business to continue to deliver really good results and the re-rating to continue. So the entrepreneurship is at the key, flexible business models, which are sort of disrupting the market. Those are aspects which are really important. Quick reminder, we don't compromise on quality. You will not see us buy Adani in India. You will not see us buy certain groups and businesses which are backed by certain families in Indonesia and Turkey and Brazil, which have traditionally taken advantage of minority shareholders. So there is a uncompromised bias towards quality. And of course, sometimes situations can deteriorate. Sometimes we're also learning more about certain conditions in companies, and it may sometimes mean that we have to sell out of a position where we simply think that there is a risk to the rights of minority shareholders. That has actually happened over the last 6 years. But if I may just come to the most important part here, country and sector allocation, where are we now? We continue to be invested quite a bit in Taiwan, despite the fact that we have had multiple opportunities to take profits in companies which were close to the fair value, close to where we sort of came to the point that the market has began to price them in efficiently. We had some new ideas in Taiwan, which we added to the portfolio. I like to remind you that many and most of these companies, if not actually all of them, are global in nature. This is not exposure to the Taiwanese domestic opportunity. This is exposure to the Taiwanese skill and engineering superiority. It's the entrepreneurship in Taiwan, which causes a global competitiveness of these businesses, and they are giving us exposure to Asia. Many of them actually successfully also operating in China with good governance. But it's really a global exposure. Whether it's semiconductor testing, whether it's IC design, especially in those areas, they're asset light, they are very cash generative, they're highly profitable, and we expect that, of course, the driver in high performance computing, establishment of more data centers around the world, with the adoption of AI into IoT, into public and private sector infrastructure, these businesses are sort of really at the very core of that trend. India, as you can see here, and by the way, just regarding Taiwan, we don't expect this weight to increase here. We are mindful about this. We're trying to limit the weight, the country weight, and this is sort of towards the upper end of our tolerance. India, a little bit different here. We used to be 25% in India. We have reduced some exposure earlier this year. The recent weakness, which is partially related to the elections that has taken place, which is partially related to cyclical aspects, which is partially related to the global economic situation. India's economic pathway is certainly not derailed. In contrary, we believe that under the Modi administration, there's still a multi-year growth path ahead of us. We see that the type of investments which are taking place in India, also the infrastructure investment needs which we are observing, but also the service sector, which is growing very rapidly. We continue to be quite excited, but we have taken profits in some ways because of the valuations. There's also a limit to our tolerance here, and things have to be put into global perspective, although India, of course, is always a special case. But we are currently reshaping and remodeling our exposure in India slightly, and we are looking at a couple of new opportunities. The biggest addition has been A361, the wealth management business. Think about Julius Baer. That's what they say themselves. That's whom they want to become. And we think that with the increase in personal wealth, household income, and the higher need for wealth management services, and we also believe that we understand these type of businesses quite well. This exposure is something we're very happy about. The other core pillar in India continues to be persistent systems, IT services. It's a global business, not the typical India exposure. It's really a global exposure. And again, we see that there's a really strong momentum here and expectations for next year, very strong, with still relatively reasonable valuation. So that's really exciting here. But expect this weight to stay more or less where it is. South Korea, I talked about it a little bit. A huge opportunity. The market has corrected a lot, not 2 days ago, but actually over the last 6, 7 months. And we are not exposed really to the South Korean opportunity, the domestic opportunity, again, we're focusing on exporters. Classes is doing really well. The recovery in demand in many countries around the world for medical devices has been driving earnings growth here, and they, with the help of Bain as a core shareholder, continue to roll out new products, continue to roll out into new markets. So expect that to continue. Similarly with atomic force microscopy, where we have a really unique business here, global market leader, again, creating a market for themselves, now catering to the semiconductor industry. So the export opportunity here with a slightly weaker domestic currency, which is actually helping. Brazil, the problem child. We have exposure. Here we do have exposure to the domestic economy. We have exposure to the ultimately households. It's a combination. We have three main pillars in Brazil. One is software, diversified software. And the second one is really a jewelry chain, which we really like a lot. And it's sensitive to interest rates. It's sensitive to domestic consumption. And then the third one is the gym operator, Latin American gym operator. So we need a bit of patience here. Brazil is going through a tough spot, and which is mainly coming from external pressure. And I believe that next year should continue to be a good year for the businesses we have. They're all defensive in nature. They're well capitalized. And the currency actually looks quite interesting right now. Turkey has beaten everyone's expectation, and including our own. Although it recently showed a bit of weakness, some correction, but long term, we've delivered a really good return in Turkey. We will certainly not buy more. We have taken profits at the beginning in the first quarter of this year, which was the right thing to do. But recently, the performance again is pushing up the way the country weight here. Now, I'm going to speed up a little bit here. China. We continue to stay, as we often say and discuss with you, we continue to stay skeptical. There are such large structural issues in China that weigh on the opportunity set. But what really discourages us the most is to invest, when we want to invest directly in Chinese companies, is the level of disclosure, the level of transparency, the exposure to and sensitivity towards regulation, the problems around the SOEs, overcapacity in every single key industry, and the real estate market, which kills the rest of the story. So, with unemployment still being very stubborn, with many of the initiatives, which in some make up around 1% of GDP, not having the desired effect, we continue to be careful here. We have added to a couple of names. We are rallying behind some more in businesses which are more Western in nature, but we continue to prefer the indirect route to get exposure to China than to buy directly. Vietnam has been a very interesting opportunity, which we have now missed for the past 6 years. I was always too stingy in a way, not willing to pay up the premium which foreigners have to pay. In hindsight, a mistake. We could have done this in 2019, in 2020 as well, just paying a 7, 8, 9% premium, and we would have made, a very good return. I've spent again quite a bit of time in Vietnam this year. We built a position in a very good company. There has been a transition of power in Vietnam to an ex-policeman who's cracking down on corruption, but who's very pro-business. And the country now, of course, also looks interesting because of some of the fear around tariffs and Mr. Trump. And it remains to be seen what really happens, but Vietnam is in a very, very strong position because of the competitiveness, because of the advantages in labor cost, So they can actually accommodate quite a lot. And even tariffs are not going to derail the opportunity set here. We have exposure to a business which is in IT services, software development, with a lot of exposure also to Japan. The rest is South Africa, Thailand, Kenya, Malaysia. Sector allocation unchanged. We're quite excited here about the software part, recurring revenue, sticky clients, but I think a lot of this you're aware of. We continue to be highly underweight to financials. This is what I really would like to spend time on, but I only have 7 minutes left. So maybe, Neil, how much time do I have? Maybe 10 minutes?
You can take 10, no problem. Yeah, we can.
Okay,
we can
perfect. So this is the story. This is the explanation maybe to most questions that we have and that you have. These companies, this is the jewelry box of the portfolio top 10 holdings. Maybe just to be respectful, I'm starting with number 10. APL Apollo has been a very important part of the portfolio since we started the strategy. It's a lightweight steel manufacturer catering to private and public sector infrastructure, housing improvement, airports, logistics centers, anything you can think of, any structural investments in India. Very high margin, the highest discipline in working capital management, growing market share, accessible management, decent governance. This business is in a very sweet position to benefit from further investments over the next couple of years in India, and they continue to gain market share and continue to deliver enormous financial discipline. So I think although we actually managed the position along the way, it would be now a much higher weight, and we had to trim the position along the way and on different occasions. It's now looking really well positioned to benefit from a recovery in investment in India over the next 1, 2, 3 years. EPAM Systems, it's really a global business. It has exposure to every single emerging market and frontier market. It also has exposure to developed markets. It has an emerging market DNA. The staff are predominantly from emerging markets. They've now shifted aggressively into India. They used to be exposed a lot to Eastern Europe, including the Ukraine. Originally, the business is actually from Belarus, or the founders are from there. And they've now moved aggressively into India, and they created a lot of delivery centers in India. Actually, they were upgraded today by Goldman Sachs, covering them. It's a better understood name, but valuation's really attractive. And we think that their capabilities, their unique capabilities, and delivery quality in IT services around the world will drive earnings going forward. Again, asset light, fast growing, and a magnet of talents. 361, I talked about this in India. This is the wealth management business where we see the potential for it to multiply in size over the next 10 years, simply because they're independent and they offer wealth management advice, and the addressable market is growing very, very quickly. Now, just picking up a few more here, it spoke about Classes in Korea, but also Park Systems, atomic force microscopy, E-ink, which is electronic paper, which I mentioned at the beginning of the call, and especially the adoption rate of electronic shelf labels everywhere around the world, from Walmart to Tesco to all the big retailers around the world, but also within airports, train stations. We're talking now about indoor signals, which are adopting this electronic paper technology. The market is growing very rapidly, and it is the owner of the technology is basically a monopoly. One interesting driver, one stock we're particularly excited about is here. It's at the moment 4%. It's a $4.5 billion company, Elite Material, and they have mastered better than anyone else to produce some of the most important and essential material which is needed in the construction of semiconductor infrastructure. So from copper-clad laminate to substrates, they work directly with some of the most very well-known businesses such as NVIDIA, but many others. The quality, the delivery quality of the business has been outstanding. The market is growing, and they're moving more and more into high-performance materials, which are used in high-performance computing and AI. So this is a multi-year driver. Valuations, we are not as cheap as the benchmark. The benchmark has a lot of banks and conglomerates, telcos, of course, that's in China. But nonetheless, we're being mindful. We're trying to be careful about not overpaying and also ensuring that we sell at the right time. This is a constant learning for us. It'll never end, that learning lesson, because I don't think we will ever get it perfectly right. But we are determining very clearly when to also sell a business at what valuations. Right now, I think the portfolio looks well positioned, not overly priced. There are clear triggers for every one of these businesses for further re-rating going forward. That, I think, brings me towards the closing comments. The portfolio characteristics continue to display what we promised at the beginning: high ROEs, very high margins, very high return on equity. These are the drivers, and this is showing the type of quality we invest in. I was about to talk a bit more about the trips we did this year, but I think most of you have been updated. Spent a lot of time in India, Taiwan, China, across all of Southeast Asia this year on multiple trips. Swati continues to be in India right now, and we feel that we have really good access to entrepreneurs. Now, lastly, few comments on emerging markets in general. The degree of underweight continues to be astonishing. The degree of interest in emerging markets keeps on rising. We can see this by discussions we're having with more and more investors. I think that the medium and long-term trajectory here continues to be very supportive, driven by technology leadership, driven by the recovering consumption in Asia. I just returned back from Asia, and the mood there is better than here. Just look at, travel activity, hotel booking, footfall into shops, same-store sales growth across different categories. They are recovering. The increasing role that businesses in Asia play in some of the key industries, including automotive, including communication, including high-performance computing, that's where they are really winning the day. So growth is there, domestic demand is there, the creation of wealth in emerging markets is ongoing. So these are trends we are observing, while actually the valuations continue to be very low. Couple of comments on China. I think I mentioned most of this. I do not expect a miracle here. I think they will be rational. They will work a lot on trying to stabilize the economy, but they have a very long way to go. So we will continue to find better opportunities elsewhere. Elsewhere, for example, in Vietnam. This is an economy which is growing very rapidly. This is an economy which is exporting globally. This is an economy which has very significant and sustainable competitive advantages: skill, cost, infrastructure, deep sea ports, over 100 million people themselves. They're very, very hungry. And the type of investments that are now moving. And by the way, yesterday, NVIDIA announced a big deal in Vietnam. So more and more very sophisticated businesses investing here. So FDI at an all-time high of 23 billion. I remember when it was around $1 billion FDI. So that's really transforming this economy. That is sort of bringing me to a close. Constructive outlook, certainly we have long-term. Earnings growth is there. Visibility has improved. I'm not going to bore you with demographics. That's all clear. But what's really the driver is this combination of innovation at a reasonable price. And let me open this now for any questions you may have.
Lovely. That's great, Carlos. Thank you very much indeed. That's very kind. And as Carlos says, we're open for questions. We have some time if there are any from the floor. You'll notice there's a Q&A button at the bottom of your screen. Press it, type something in. If you have a query or a comment, then we're happy to respond to that. I mean, I guess just to get the ball rolling, Carlos, there was an article in The Economist the other day which was talking about I guess one of the feelings that many investors are having, which is, should we just pull up stumps and just invest in the US now? I think the view that you'll have is obvious, but I don't know if you can give a response to that kind of article that we see out there in some of the financial journals at the moment.
Yeah, those are the type of views and comments which normally indicate a turning point. And I would say they will be seen as a mark of when you should actually do exactly the opposite. But I mean, fundamentally, I understand where they're coming from. And of course, over the last couple of years, the question is, do you mean the US or do they mean the 7 stocks? And I can only say this: we have more than 7 stocks that have done better than Nvidia, even over the last 5 years in emerging markets. It's about what you buy. It's about whom you back. It's about the business model. It's about the type of company you invest in. I mean, Persistent Systems is a 12-bagger. APL Apollo is a 6-bagger. We're looking at many positions in the portfolio, as I said, should multiply in size. So I see that as a tremendous opportunity. I don't think that the whole world should just be invested in Nvidia. I would be careful about this. Also, you have to fundamentally question the strength of the US dollar. In the previously when Trump came in, it also was a bit of a roller coaster. It's not a one-way street. I think to diversify makes sense. We are careful about the type of currencies we do invest in. Most of the currencies we invest in EM are actually quite stable, and they have a good outlook because of the very, very strong external account, very strong export. So that's positive, with relatively, contained public and private sector debt. The answer to me is, is clear. I think it's such a consensus overweight right now in the US. I personally would rather think that this is the time when you should be careful. And as I said, opportunities are everywhere. Opportunities are not just in the US, and specifically with the transition and transformation of the business models, which I tried to talk about earlier. There are opportunities which are, I think, more attractive than an Nvidia or Meta or Amazon in the US.
Yeah, no, that's very useful, Carlos. I tend to share your views there. We've got a couple of other questions that have come in. So you mentioned Korea, and has the situation changed your view on the country at all post the midweek toings and goings?
Well, I'm still trying to recover the sleep I lost. However, we're looking at, the fundamental facts and circumstances which impact asset prices in the country, and whether or not they have actually any impact on the businesses we invest in. So if you look at Classes, they have not been impacted whatsoever. If you look at Park Systems, they have not been impacted whatsoever. If at all, then slightly positively because of a slight depreciation of the won, but that's also not been too meaningful. What's more important is, as I said, it showed how strong the checks and balances are. We do expect an impeachment process now. We do expect the various fractions, the various political parties to rally behind the constitution and ensuring the functioning of the pluralistic democratic system in Korea. There's no doubt in my mind that it is strengthening Korea. Um, and it could be very good news for the private sector because some of the if the Democratic Party is going to win, which is, I think, a relatively reasonable assumption, and you look at the agenda they have, it's very much in favor of further governance improvements in Korea, which can and would lead to further re-rating of the Korean economy. And remember that Korea has embarked on a pretty widespread initiative to copy Japan, make Japan better, greater, faster, more competitive, and so has Korea. And the recent developments especially in governance, interesting, and also evident by the fact that there is more and more corporate activists, both domestic and international, taking stakes in Korean businesses, joining sort of that whole thesis of better governance, which will lead to more buybacks, which will lead to higher dividends, which will lead to better capital allocation. Korea continues to be very astonishing.
Thank you, Carlos. What about your thoughts on China-Taiwan tensions, please? Could you give us a brief update on that at all?
Brief, okay. It's quite stable. Everybody's acting quite rationally right now. And nothing really has changed. We see that the language is certainly has sort of is calmer than in previous periods. The risk of China and Taiwan moving again into a sort of more uncharted waters, more volatile territory is clearly there. It could be triggered by any unforeseen event. But I think that at this stage, the overall aims of the Chinese administration are very different than to further pour oil into the water there. They want to stabilize employment. They want to strengthen the private sector. They want to establish the RMB as a reserve currency. They certainly want to work on strengthening their exports and establishing a broader, healthier domestic economy. And none of this, I mean, all of this would be jeopardized by a military conflict. We've been saying this for quite a while. But nonetheless, we're keeping a close eye on this. We keep discussing this situation. The businesses we have invested in Taiwan they're global. They're literally global, and it's also interesting to see the correlation between the Taiwanese market and the S&P 500. It's very, very high, and we have asset-light businesses which have production all over the world. If things would deteriorate, we would certainly adjust our view, and we also have invested in very, very liquid names. But it's not my assumption. It's not my expectation that there would be an increase in tension at this stage.
Thank you. That's very useful. Got a question on Mercosur. Apparently, the French turmoil has increased likelihood of Mercosur. Thoughts on the potential impact there? I think, reading between the lines, I think that means the debate about trade agreements between those countries and France is more in focus now, and whether you have any views on that at all, Carlos?
Plays very little, plays close to no role for the businesses in our portfolio. And I think, I mean, overall, the bigger driver, I actually see the bigger driver right now for the main trading regions which we focus on, including Latin America, are further stronger trade relationships between especially the EU and those regions, which are that's certainly being worked on. But what we really need to watch out for right now is what the US is doing. That's going to be a lot more significant, and whether there will be universal tariffs or not, and how these tariffs will impact businesses and economies. That's the key thing to look at, to watch out for. And there will be very obvious victims, which one needs to be careful about. There's going to be certain sectors which will be targeted by the US. We've seen quite a bit of this already, but it will get a lot tighter. And there will be others who will benefit in a big way from these shifts. And that's exactly the type of work we're doing now. We are liaising very, very intimately with companies, trying to understand if there's anything we are missing. Since most of our companies are exporting and mastering intellectual property, as opposed to, selling low-end, low-value goods to the US, which are then sold in Walmarts, they are far more protected. And also, since we have from the beginning said we want companies with a deep moat and companies that are able to for the most part, control their own pricing. So on the other end of the commodity spectrum, that's another insurance policy which is baked into the business model of the companies we have in the portfolio. But nonetheless, we're watching this very carefully. I would expect a lot of turmoil next year, not just again I think we have to expect that there are going to be a lot of personnel changes and then changes again, as we've seen before. And there's going to be very rough language and threats. But then the actual deals which they will make will look quite different in nature. And it's also, it's good to see that emerging markets, businesses here are very well prepared. And they've diversified, they have strengthened the business model, they have diversified income streams, they have strengthened their leadership in many technologies. And the overall dependency, let's say, just on the US market is also one that has actually come down quite a bit over the last couple of years, especially in Asia.
Great, thank you. And one final one on going back to Korea again, and a query about what the opposition party view is on value up, which I think is the sort of corporate governance program that was announced in February this year.
That's exactly what I alluded to. So that's one of the value up initiative is one of the major drivers, and that's so if you actually look at the corporate governance improvements, the transparency improvements, and the number of companies which are now in one way or the other dealing with activist campaigns is at an all-time high. I would again, I like to reiterate that the chances of the opposition party to come in after an impeachment of the president is in our mind a potential trigger which would create a lot of sort of potential upside for Korean equities, as there are right now, if you look at the agenda and if you look at what they've been saying, what they are trying to do, a revision of commercial law and various actions that will boost market support and that will boost businesses. So I think that's something it's a bit early to say this now. We haven't even seen the impeachment. The impeachment will take actually between 3 and 6 months. But there's potential that, especially now after Korea, actually look at Samsung's share price. Not that I would buy Samsung, but it's just a good way to measure what's going on here. There's also been quite a bit of derating taking place already. I wouldn't get exposure to Korean banks or to a lot of the domestic plays. I rather think that it's interesting to look at business models in Korea, which are giving us exposure to the rest of the world, which have now sort of become collateral damage of this negative domestic sentiment. But Korea up, just to come back to the beginning, is I expect this to continue. It has broad support, and they see this. It's supported by entrepreneurs. It's supported by big conglomerates. It's supported across different parties. So that's ongoing.
Lovely. Thank you very much indeed. And Carlos, thank you for your time today. And ladies and gentlemen, thank you all for joining us also.